So interest rate decisions, either by lowering them or increasing them, it may affect the country very significantly. And not just the country, but the participants of financial markets and the stock markets. There are rate cuts coming up in this month, but what if those rate cuts will endanger the economy? Why might that happen? Well, you can stay tuned and continue watching this video. So what role do interest rates play in the economy? So central banks have few instruments in their arsenal when they fight inflation, and one of them is to increase or decrease interest rates. When the central bank increases the interest rates, it's fighting inflation, but overextending those interest rates might slow down the economy too much, and there will be side effects like decreased GDP growth. But then again, if you're lowering them too soon when the inflation is high, that can cause additional problems like additional inflation. For example, if you have interest rates high up, the inflation is still strong, and you then lower them. By lowering the interest rates, you stimulate borrowing and investment, and overall the outcome of it is increased money supply in the economy, which will provoke more inflation. So in those circumstances, lowering the interest rates is like a double-edged sword. Currently, the US household debt is at around record high level, approximately $21 trillion. Corporate debt isn't far behind, it's around $21 trillion as well. And then there's the government debt, which is $30 trillion. With these record high levels, it's actually a question of sanity. Will the US economy prevail or will it fall? Because it might enter a hard recession, or the dollar might start to devaluate. Let's discuss these details in the further chapters. Let's talk about short-term gains and long-term risk. When interest rates change in the short term, either up and down, who benefits the most from it? Of course, it's the speculators on the financial markets, especially in the currency markets. That's because in the currency markets, the volatility is exceptionally high, and speculators, if they can anticipate where the rate hikes will go, they can benefit quite a lot from it. You have to understand the economics and everything that comes with it, so that you could anticipate where the price will head next, or what will be the outcome of the monetary policy decision. Another financial sector that can benefit from this is So for example, if the interest rates are high, then financial institutions that give out loans, they receive a higher yield back because of the interest rates. So each loan they make, they get a higher yield back. On the other hand, when the interest rates are low, the demand for loans increases. So even though the interest rate isn't as high, but the demand for loans is much higher. So here you win with quantity over quality. Overall, the interest rate changes in the financial markets is a very risk-averse situation. You have to figure out where it's gonna go, where it might not gonna go, and you have to look at the situation from multiple different angles and be aware of the risk that you're taking. Let's talk about the long-term risks. Lowering interest rates on the long term is very problematic because, based on real interest rates, which are currently at 1.6%, and the interest rate itself is at around 5.5%. This indicates that inflation is still very strong and persistent, and it's not going anywhere. One of the other problems is, if you're gonna lower the interest rates, it's gonna stimulate borrowing and investment. When the financial institutions start to give up money, it will create additional inflation, and based on the already existing inflation, if the money printing machine won't stop, this inflation can spiral into hyperinflation. And when the government crosses the line, and when money printing isn't as bad as stopping the money printing, then it's already very too hard to stop the money printing machine because the side effects will be catastrophic. So, in order to avoid that, the country must keep a balance of its income and spending. You have income and spending, you have to keep a balance between it. If you're spending more than you earn, which is a deficit, then you have to print more money to sustain your spending. And that, as I said, can spiral into hyperinflation. And as US consumers are already at record high debt levels, credit card debts are maxed out. And just because the inflation is so strong and the grocery prices are so high that consumers can't afford to buy groceries on their own payrolls anymore, they have to take credit card and max out those credit cards. Lowering interest rates is a very questionable thing to do because the long-term risks are very significant. So keep in mind this information that you received, and let's move on to the next section. So let's talk about sector-specific impacts. The housing market, for example, suffers the most from the high interest rates because high interest rates lower the demand for mortgages, and those that already have mortgage debt on them, this increases their burden even more. Besides that, the construction sector isn't performing as well because the demand for new housing has lowered, and so because of that, the construction sector is underperforming. Stocks, on the other hand, might benefit from the lower interest rates because when interest rates are lowered, it becomes more profitable to take on new debt, refinance debt, or expand in investment. And because of that, the companies may take on new debt to refinance their existing debt, which will increase their profits in the future. But if the inflation is sticky and persistent like it is now, these lowered rates might increase in the future, which will increase the debt burden even more on these companies. Meanwhile, the gold price is at record high level. When gold rose from $700 approximately in 2007 to $1,800 in 2012. Those were the side effects of Fed's quantitative easing programs, which set the trigger for inflation in the future. So, the crisis started in 2007-2008, and it moved on to 2012 approximately. And during that time period, gold increased by $1,100. And now it's trading at $2,500 after the pandemic, which means the inflation is very persistent and it's not going anywhere. If the inflation wouldn't be a problem, gold prices wouldn't be as high as they are now. So that's also something for you to think about. So in summary, while lowering interest rates might be beneficial to sustain economic growth, it's not such a good idea because the inflation is still persistent. It will be much more wiser to increase the interest rates. But if you increase the interest rates, sectors like housing and construction, they get hit the hard. On the other hand, maybe it would be a wise idea to devalue your dollar and invest in manufacturing so that your exports would be more attractive. Let's discuss some investment strategies. So the obvious investment would be gold or silver because they're the safe haven assets that you should buy in any inflationary situation. Well, it might be too late now, but you never know because the rumors are that the dollar is gonna fall sooner or later. It might be true because if you notice where the economy is heading, where the currency is heading, it might be possible that the dollar will devalue itself if the interest rates will start to get lower and the inflation persists. Then it might be a big problem for the dollar. But overall, the current US GDP has shown a significant growth, growing 3% till now in 2024, up from 1.8% that was predicted at the beginning of this year. So while the economy is still growing, sectors like finance and construction are in a recession, not to mention manufacturing, but that's a topic for another video. High interest rates put pressure on finance and the construction sector, particularly the real estate, because taking loans isn't as profitable as it is due to high interest rates, and that goes for mortgages and for loans by themselves. Despite real interest rates being low as 1.6%, they're still expensive. The agriculture sector is also in a recession mostly because of the US trade war tension till now. The agricultural sector lost one of its biggest markets, and that's China, because of the trade war that was going on. And not just that, the climate change is also influencing the agriculture, because farmers can't grow their crops as well as they used to in the past because of the heats, wildfires, and so on. It's also important to notice that if the interest rates will get lower, then the sectors like technology and artificial intelligence especially will see significantly more investments. They're already being invested heavily throughout this year and the previous years, and they might get even more investments because the interest rates will be lower. Well, where else should you invest if the technology is booming like second decade in a row? Of course you invest in technology. Safe haven assets like gold and silver are also viable, but overall it's technology because it's booming, we're evolving thanks to technology. Of course invest in it, why not? So in conclusion, the opportunities in today's landscape are very significant. Things can go sideways, things can go up, things can go down, but that's for you to decide where to go. You have to be smart enough to figure out how things might turn out in A or B scenarios, and based on that you earn money. But in the end you have to do your own research and diligence. So overall, if you like this video, please like and subscribe, and I will hope to see you in my future videos. So, bye.